This is Will McCauley with Sea Intellect. I'm going to review this week's proprietary research and analysis piece on crude oil. Specifically, we're going to look at the recent sharp decline that we've seen in the crude oil price and what is potentially behind that decline. We've had a number of clients ask us who have both watched the run-up year to date and then the steep decline and asked us for our take on what is happening in the market and where we think things are going from here. We've had a number of RNA pieces this year that lead into the piece that I'm talking about today. So this is a summary of past pieces. I'm looking at why we think fundamentals are finally being truly recognized in the market price, and we think that while declines have been steep, we think we're getting closer to a bottom. We have taken a neutral position after being bearish for a long time crude. We're going to reassess fundamentals and see where we think prices go from here. I'm looking at the recent sell-off. About the beginning of October, the crude oil price for December was $76.50. In that intervening 6-week period, we've seen the price decline around $20 a barrel to $56.50. It's been an extremely sharp decline. Even as of the past 2 weeks, the price declined for 12 days straight, setting a new all-time record, and it has declined for 13 of the last 14 days. So it's been pretty sharp decline as we go into the expiry of the December contract. As I'm looking at the decline, there's really three main buckets that I want to talk about today. The first is the supply side of the equation. The second is the demand side. Specifically, we're going to look at both emerging markets demand for crude imports and then United States demand in the face of high prices. And then the last thing we want to talk about is how the US dollar impacts the crude price. So digging a little bit deeper into the supply, prior to Iranian waivers, we believe the market was in a modestly oversupplied position. We think that the production gains in the United States, Saudi Arabia, Russia, and even the United Kingdom far outweighed the declines that you saw in both Venezuela and Iran. So going in to the beginning of the month, the world was in a moderately oversupplied situation. Once the United States granted export waivers to Iran, we went from a moderately oversupplied situation to a grossly oversupplied situation, which I think just exacerbated the decline in price that you're already seeing. On the demand side, there's really two factors. The first is emerging markets demand, and there's two pieces to the equation in emerging markets demand. The first is the nameplate price for crude in dollar terms, and then the second is the emerging market currency devaluation that you've seen relative to the United States dollar. Those two factors compound each other and make imported crude oil prohibitively expensive in certain countries. The second demand factor is the United States price elasticity. We think the elasticity is stronger than many people think, and that above $66 a barrel in the United States, you start to see demand destruction from high prices. We think this is a bigger factor than many people are realizing. And then the final is the United States dollar. So the United States dollar has been on a run. It's up 8.8% over the last 30 weeks. And for every 1% increase in the dollar, you see a crude price decline of around $2.75 a barrel. We'll go into much more detail about that relationship and have a little storyboard as to why that is the case. Turning over now to more detail on the U.S. demand destruction, the chart that you see on the left here is the WTI prompt crude price plotted against the year-on-year percent change in the United States demand. As you can see, there's a negative relationship here. The correlation is about negative 0.73. So that's a pretty strong negative relationship. Again, above $66 a barrel, we see demand destruction, demand declines in the United States, and below $66 a barrel, we see increases. We think for roughly every $1.50 per barrel price change in crude, you have about a 1% change in the demand in the United States. Given the volume of crude that the U.S. consumes, that's a big overall volumetric number. And we think, again, this is a little more sensitive than most people believe it is. People believe demand in the United States is relatively stable regardless of price. We disagree and think that's not the case. The second thing to look at is emerging market priced crude oil in local currency. So the chart on the left has two bars. The bottom bar was the crude price increase as of the time we did this proprietary research analysis piece. So Brent at that time I think was up around 39% year to date. The black bars represent the additional local currency price increase from devaluation of the currency. So in the case of Turkey, the domestic imported price was up over 100% at the time of this publication. That's a very strong headwind that these countries are facing to import crude. Now you need to look at both currency change, but then also at the volume associated with the countries that have had significant price changes. Now that is the chart that you see on the right. Again, that is ordered the same way in terms of largest price increases in local currency. However, the two big countries to look at here are India and China, because they are the biggest markets for crude imports from the US and worldwide, for that matter. So again, as of the time of this research and analysis piece, we expected somewhere between 500,000 and 900,000 barrels a day of demand destruction simply from crude price increases and local currency devaluations. The next item to look at is the US dollar and its relationship to the crude price. The chart on the left that you see is the crude price in the brown color, and then the US dollar on an inverse axis in the black. So you can see there's a relatively tight relationship. Yes, there are periods where this relationship diverges, but overall it's a pretty tight relationship. We found that the US dollar explains roughly 50% of the crude price change, and then the rest is explained by other fundamental factors. On the right, you see a theoretical country called Xanadu, which uses a currency called the ZAN. And really this is meant to illustrate what local non-US based producers do in the face of changes in the US currency rate and what that means for their profit. So let's start on in the top right here. So in the top right, the US crude price is $70. Converted into the local currency, it's 198 Xanadus versus their production cost of 180. So they're willing to produce crude for an 18 ZAN profit in a steady state. What you see below is a situation for a first step impact and a second step impact. So in the first step, the US dollar declines. So it goes from 2.8 to 1.8. And the crude price in this case has stayed the same. Well, you will see that as the exchange rate has declined, the Xanadu profit has gone from a positive number to a negative number. So now they're losing money on all of their production. There's two things that they can do. They can cut production, reduce supply, which will increase price, or they can just withhold supply, store it, and wait for higher prices later. Either way, you get to the same outcome, which is the dollar declined, producing countries are not making a profit, they have to increase the price to justify continued production and continued investment in their industry. So as the price increases, it levelizes back to the same profit that they were willing to accept previously of 18 ZANs per barrel. Again, this is a very simplistic, illustrative example, but it's really the fundamentals of what's going on behind the US dollar from a non-dollar denominated producer perspective. The final thing I want to look at, which the market hasn't really talked much about, is the relationship or the ratio of the crude price divided by the natural gas price. So the chart you see on the left here is since the inception of the natural gas futures contract in 1990, you can see the trading range of this ratio of these two products. Over that period, the median has been about 11.1 ratio. You see obviously a strong increase in the 2012 timeframe. We've come back down as of late, but we are still above the median, currently at about 12.9. So in order for this ratio to fully revert back to the median, one of two things can occur, or a combination thereof. If the natural gas price stays where it is, crude oil will have to fall to $49 a barrel to get to the 11 ratio. Or if crude price stays the same, gas will need to increase to $5 an MMBTU to get to that same median ratio. We don't think that's going to happen tomorrow, but ultimately we believe we should trend back towards the median over the long 28-year history. So we don't necessarily think the price moves that we've seen to date are done. We do think the market is getting more realistic in the fundamentals and the oversupplied situation that it sees, hence the price declines that we've seen in crude oil. For much more detail on this RNA piece and all of the individual RNA pieces discussed in this video, please visit our website at cintellect.com.